Everybody, welcome into another Monday live stream. We are kicking this off. I am Dion Rabouin, a reporter for the Wall Street Journal, covering markets, and we're going to be talking about everything going on, what you should be looking out for this week in markets, as well as looking back a little bit at last week, talking about what the big events were and how they're going to impact things, not only this week, but going forward, talking about stocks, bonds, oil, commodities, gold, basically all the big markets. We're going to be getting into all that and really what we think all of you out there should be looking out for, and what I think you should be looking out for this coming week in terms of data and in terms of market happenings and economic data that's going to be coming out the rest of the week. So for this week, we've got a lot of data that I think is going to play a big role in what we can expect to hear from the Federal Reserve in May. And as we know, central banks drive markets. So right now, I think the market is looking at three things. That's inflation, inflation, inflation. And this week is going to tell us a lot about inflation. So thanks again for being with us here on the live stream. We're going to be trying this out for a little while. We're also going to be doing a bonus live stream for you this week, so I hope you'll tune in for that as well. But gonna get into it today. I want to talk through, first of all, what we can expect this week and what you should be looking out for. Then want to get into what happened last week and how that's affecting and moving markets going forward. So this week, I think the big release on the market calendar is going to be that CPI number, the Consumer Price Index. That's going to tell us what inflation has been over the past month, the change in the past month, and it's going to tell us the change over the last year. Economists have an expectation for a pretty large number. We're going to dive into that and tell you just what that means. Also, we've got the PPI report, Producer Price Index, coming on Wednesday. I'm going to tell you what that is, why it's important, and how that relates to what folks are going to be seeing on the shelves and at the pump and all that going forward. Also, we've got, like I said, a big slate of data, not only Consumer Price Index and Producer Price Index, but U.S. retail sales, that's coming out on Wednesday, and the University of Michigan's Consumer Sentiment Index coming out on Thursday. So every day we get a new report that's going to tell us, I think something very important about inflation. So I hope everyone will be tuning into that. I know I will be, and we'll be talking about what all that means at the end of the week on Friday. Just check in. Let's look at the markets right now on WSJ.com. Looking at the Dow down 0.6% right now. The S&P off 1.1%. The NASDAQ down 1.5%. A rough morning on markets, and it doesn't seem to be getting that much better as we move into the afternoon. The 10-year sitting at about 2.77%. Really has moved up significantly over the past week. We've also got oil down about 4%. That's WTI, the U.S. grade. Brent crude down almost 5% at $98 a barrel. We're seeing some real significant moves there. And gold up about 2%. So significant moves up in gold. We're seeing the market really moving to start off this week, even though we haven't gotten a whole lot of information. So again, we are here, we're doing this live stream. I'm Dion Rabouin from the Wall Street Journal. And I hope you'll join us every Monday as we talk through what to look for, what to look out for in markets, and look back at the week that was before. So I want to jump into a report we got today that I think wasn't really on a lot of radars, but I think it really caught folks by surprise, the numbers that we got. And that's that New York Fed survey of consumer inflation expectations, or excuse me, the New York Fed survey of consumer expectations. The number that I think jumped out at folks was the inflation expectations rising to 6.6% over the next year. That means folks out there are expecting inflation to rise by 6.6%. That is well above what the Fed has told us they expect inflation to be. The Fed has said 4.3%. So you're seeing a gap there between what consumers say and what the Fed says of more than 2%, which is the Fed's inflation goal. So the expectations for inflation well above that, but differing from the Fed's expectations by more than 2%. When you dig into those details, just want to get into that really quickly. Median expectations over a 3-year period actually declined to 3.7%, largely because of folks who earn less than $50,000 a year, don't have a college degree, their expectations over a 3-year period declining. Uncertainty, though, about inflation over both 1 and 3 year periods rising to a record high. So folks saying we expect prices to be higher. We don't know by how much, but we think that prices are definitely going up and by a significant amount. Also want to point to that year ahead household spending expectations rising by 1.3 percentage points. Now, that's the highest increase on record between surveys, meaning that folks saying from the last time they were surveyed to this time, we expect inflation to rise by more than 1%, 1.3%, the highest level on record. That's a big number. Rising to 7.7%, that's also a record high. So again, thanks for being with us on the live stream. We're gonna dig into now all of what is coming for us this week. We got that survey from the New York Fed. Also want to point out really quickly before we move forward, the number of consumers saying that credit will be harder to obtain over the next year rose above 50%. That's the highest level ever on record for the survey. Number of consumers saying credit will be hard to get. That's very interesting because we really haven't seen those rate hikes from the Federal Reserve play into credit cards and things like that because they've only raised rates one time. They're projecting to raise rates a number of times this year, but the actual impact of the Fed's actions hasn't begun to hit credit yet, and we're already seeing more than half of consumers surveyed say they think over the next year credit will be harder to get. That's definitely something to keep your eye on. Since December, we have seen a consistent decline in expectations for household income growth, while we've seen a consistent increase in expectations for household spending. When you break it down, households are saying, look, things aren't good, we expect to have to pay more, we expect to earn less, and that's why you've seen these consistent low numbers for consumer sentiment, consumer confidence, and things like that. So as we look forward to this week, must-see TV, I think Tuesday at 8:30 a.m. Eastern time. I don't know where you'll be. I'll be right here in front of this computer looking at that CPI report. The Consumer Price Index is expected to show 8.4% increase year over year in inflation, 1.1% increase month over month. Normally we talk about those year over year numbers because this is again projected to be the highest rate of inflation in about 40 years. But I want to point to the month over month number, which is expected to be 1.1%. That's going to be some of the highest inflation we've seen in years. When inflation starts to rise more than 1% month over month, you start to get in some worrisome historical comparisons. If we beat this pace of 1.1% month over month, the projection, we could start to get towards the highest rate we've seen since October 2005, 1.4%. That was the second highest reading all time for the CPI, which dates all the way back to the 1970s. The highest rate we saw month over month on the CPI was 1.8%. That was in September 1973. I say all that to say that we are starting to get back to those 1970s levels potentially in terms of the increase in inflation month over month. So that's definitely something to watch out for. Like I said, CPI, 8:30 a.m. on Tuesday, U.S. Eastern Time. I'll be watching, the market will be watching. I hope you're watching. Now, a less followed report than CPI is PPI, the Producer Price Index. But I think that's going to be big because PPI in an inflationary environment sort of signals where CPI is going to go. So what businesses are having to pay for their labor, for their inputs, for commodities, things like that. They have shown that they are passing those prices on to consumers. So when you see an increase last month in PPI of 10%, well, you can expect to see that CPI, consumer inflation, rise. This month, economists are expecting that we'll see for March a 10.5% increase in PPI. So that shows that, again, inflation not coming down, not leveling off, inflation is rising, and costs expected to continue to rise for businesses, continue to rise for consumers. We'll see if that number comes in as expected. If it does, you can probably expect to see inflation continue to rise for consumers moving forward. Be sure and check out if you're not sure about that connection, right? Like, oh, well, how does what businesses pay impact consumers? We did a video called Why Big Companies Love Inflation, really kind of sussing out that connection between large companies and rising prices and how that pushes higher inflation. A lot of people think inflation is something that just happens. No, people make inflation happen. That's CEOs, companies raising their prices. That boosts prices for what we pay on the CPI, Consumer Price Index, and raises inflation. So check that video out if you have a second. Another report that we'll be seeing this week, U.S. retail sales. That's coming out on Thursday, and that's going to tell us how consumers are reacting to higher prices. In in March, we saw February's report, which said retail sales increased 0.3%. That was a huge drop off from the January level of 4.9%. Economists are expecting that to hold level at 0.3%. But remember, CPI inflation is expected to rise at 1.1%. Retail sales expected to rise 0.3%. Prices are rising at more than 1%, and sales aren't expected to rise at even half that level. That means consumers are pulling back. So the number we get there will tell us, okay, we know that consumers have a lot of savings built up. A great report from the Brookings Institute came out a few weeks ago that said consumers have amassed an estimated $2.5 trillion in excess saving since March 2020, or between March 2020, January 2022. Are they continuing to spend that increased savings? Are they going out and shopping, or are they saying, you know what, prices are way too high for me, I'm staying home, we're not gonna go out to eat this month, we're not gonna go shopping, we're not gonna take our trip to Yellowstone or wherever, we're staying inside. So I think that retail sales report is gonna be very important. Again, I want to thank everybody who's joined us on the live stream for being with us. I know you could have been anywhere in the world, but you're here with me, so I appreciate that. The other big thing next week, let's not forget the start of earnings season. This, I think, relates to inflation as well because it's going to tell us what companies are doing about inflation. In that report, Why Big Companies Love Inflation, I talked about listening to company earnings calls and telling them, and them, the CEOs, telling all of us, or the folks on the earnings calls, hey, we are raising prices. We are taking advantage of this inflation and increasing our prices and increasing our bottom line. We're going to find out if we're going to hear that from these companies this time around, or if they're going to say, yeah, inflation is really kicking our butt. We're not sure what to do about it. Obviously, they would phrase things a little bit differently because you want to make investors feel confident about the stock. But, how are they dealing with inflation? What are they doing? And we're going to hear next week, or from this week, from JP Morgan, Wells Fargo, Citigroup, a lot of banks and financial companies. They're expecting to see a year-over-year decline of 36% in terms of earnings. And that's largely because they're putting a lot more money away in terms of loan losses. We saw this when the pandemic hit the US in the start of 2020. And it looks like we're seeing it again. It looks like banks are saying, you know what, we're a little worried about the economic environment. We're putting a lot of money away in terms of our loan losses. So we'll see just how much that is and just how much that weighs on earnings. FactSet broadly is expecting 4.7% earnings growth for the S&P 500. That's below historical trends and would be the lowest since the fourth quarter of 2020. So those big 2021 earnings growth numbers that we saw look to be kind of fading away, and it's looking like we're going to start seeing more moderated earnings growth. But, and this is a big but, despite everything we've got going on, inflation, the war in Ukraine, this COVID outbreak in China, lots of other things, you have right now more buy ratings from stock analysts on the S&P 500, on S&P 500 companies, individual companies, than we've seen at any time in the last 10 years. So despite this kind of challenging environment for companies and for the economy broadly, more buy ratings on companies within the S&P 500 than at any time in more than 10 years. That's from my man John Butters over at FactSet. So definitely something to watch out for because analysts have a pretty rosy outlook for the market, even though we've seen this kind of decline. We will also see on Thursday, the University of Michigan's Consumer Sentiment Index. That'll tell us if consumers are as rosy about the economy and how things are going as stock analysts are. I think that's also going to be a big report to watch out for. So that's what we've got coming up this week. Again, I want to thank all of you all for being with us here on this live stream. We're talking through what to look out for this week in the markets. I want to take a second and step back and look at last week, but again, I want to thank you all for being with us here on the live stream because we are talking about what you should be watching and what I'll be watching as it comes to, and as it's, as we've gotten to this place where we are right now in the markets. If you watched the live stream last week, thank you for doing that, and thank you for coming back. But you remember I talked to you about the two big important events that were going to happen. That was Fed Governor Lael Brainard giving a speech at the Minneapolis Fed, and that was the FOMC minutes, the Fed's meeting minutes, coming out on Wednesday. Well, that Lael Brainard speech on Tuesday moved markets huge. Not even, it wasn't a minor event in markets. I'm going to tell you all about how big that was. But before that, I want to talk about this call for recession. Lots of people talk about recession a lot. You had the yield curve inversion, and we saw last week 2 economists from Deutsche Bank, well-known bank. They have a good reputation on Wall Street. 2 of their top economists, PhD guys, one based in the US, one based in Europe, say in no uncertain terms, we predict a recession in 2023 for the US, and we expect a significant growth slowdown in Europe. It's interesting because not even a week before that note came out, Barclays had a note out, recession, haha, April Fools, right? Well, not even 2 weeks later, you have Deutsche Bank saying, yeah, no, we are calling for a recession in 2023. They note, and I want to read exactly what they said, quote, our call for a recession in the US next year is currently way out of consensus. We expect it will not be so for long. We shall see. We'll see. That's Deutsche Bank economists David Folkerts-Landau and Peter Hoop giving us that prediction based on the war in Ukraine being extended, being drawn out more than I think a lot of folks expected, and a, quote, elevated buildup in momentum of inflation. And also expectations for what the Federal Reserve is going to do about that. Right now, the market pricing in about 3% rates, 3% interest rates from the Fed by the end of the year. That is well above what the Federal Reserve brought interest rates to the last time they raised rates, which was just 2.5%. And then if you'll remember, Fed Chair Jerome Powell did that Powell pivot, which is kind of famous in markets now, reversed rates, started cutting rates, and the US economy couldn't even handle 2.5%. Now the market is predicting that we'll get to 3% before even the end of the year. And a lot of that had to do with the speech that we got from Fed Governor Lael Brainard on Tuesday. She really pointed to inflation hurting lower income households. And the reason the market took such note of that was because Fed Governor Brainard is known as a, quote, dove, meaning that she prefers keeping monetary policy loose, keeping rates low, doing more things like quantitative easing to help out a lot of what she's pointed it to as those lower income households, as black folks and Hispanic folks, folks who have historically been left behind in recessions, and saying, hey, we've got to keep rates low to help those folks get jobs. Now she's saying, you know what, flip that, turn it on its head. We've got to raise rates and get inflation down to help those lower income folks. If you looked at the market, that speech was released at 10 a.m. The text of it was released before she even started speaking. The market had hit 45.89 on the S&P 500. That was the highest that we got. We still haven't gotten back to that level. That was the highest since March 30th. It crashed after that. We have not gotten back to that level since then. And it was clear that the market did not like Fed Governor Lael Brainard and what she said. Not only was it about raising interest rates, she talked about the balance sheet. Cutting down the balance sheet the Fed has amassed over these past 2 years, taking the balance sheet from over $4 trillion to now almost $9 trillion. They're saying they're going to start to let that run off as soon as May. Fed Governor Brainard said they could start to let that roll off as soon as May, saying, quote, we are committed to bringing inflation back down to its 2% target, recognizing that stable low inflation is vital to maintaining a strong economy and a labor force that works for everyone. So really the same terminology that Governor Brainard used about keeping rates low and doing QE, she's now using to talk about why we need to raise rates. And that balance sheet runoff is key because it adds more tightening. It makes the economy tighter. It pulls that stimulus out of the economy. It pulls money out of the economy and makes things harder, makes it harder to get credit, makes it harder to buy things that you need to get credit for. So again, this speech by Fed Governor Brainard was big last week. It's what the market watched and really reacted to, and we saw that. So I want to thank you guys again for joining the live stream and for being with me here on YouTube. I'm WSJ Markets reporter Dion Rabouin, for those of you who tuned in and are like, who is this guy talking? Thank you for being on my channel. I appreciate that. The other big piece of that puzzle last week was the FOMC minutes. The minutes from the Fed's meeting in March came out last week on Wednesday. Those told us that, yes, not only are we thinking about raising rates and raising them faster than we were previously, we are looking at running off our balance sheet, reducing the amount of bonds that we hold that's pushed money out into the economy over these past 2 years and reining that back in. If you remember, the Fed's balance sheet is now at about $8.9 trillion. Back in February 2021, it was about 4.12 or $4.17 trillion. So more than double in just 2 years. And if you remember back in 2007, the Fed didn't even have $500 billion on its balance sheet. We're now approaching $9 trillion. And it looks like that balance sheet that has pumped so much money out into the economy, a lot of that money that's gone into the stock market, gone into equities, is going to now have to be pulled back. There's not going to be more money pushed out to buy bonds. And in fact, the Fed is going to let those bonds mature and roll off its balance sheet. That makes economic conditions tighter, and it's going to make credit less affordable and things like that for consumers. The key term in those Fed minutes, and the key term used by Fed Governor Lael Brainard, it's been used by Jay Powell, expeditiously. We are going to expeditiously start raising rates. We are expeditiously cutting down the balance sheet. We're doing these things faster. We are hitting the markets faster. And that's why I think you've seen this big jump in rates on the US interest market, the 10-year, now at 2.77%. That's why I think you're seeing bond yields jump up. And that's why I think you're seeing this big sell-off in the NASDAQ, down now 1.5% today to start out the week. They're talking about doing $95 billion in runoff a month. That's a cap. That's a maximum, not a minimum, but that's a lot. That's a big change from this stimulative environment that we've seen for a long time from the Fed, and they're saying we're going to do this expeditiously. I think that makes a big difference because, again, a lot of stocks in the market, we saw as recently as last year, about 20% of large companies in the S&P 500 are unprofitable. They are zombie companies, quote unquote, which means that they don't even earn enough in profit to pay off the debt or pay off the payments on the debt that they have. So when you're running a business like that, as about 20% of large US companies are, it makes it hard when rates rise and it gets more expensive to borrow money to keep your business going. Now, we haven't seen that really start to hit businesses yet. We haven't seen a significant increase in default rates on bonds and things like that. But as rates start to climb, that could be something that we see in the market. And that's not good for the stock market, obviously, and that's not good for the US economy. Big businesses can't borrow as cheaply, which makes it harder for them to run their business, which adds costs and, slows down hiring, slows down profitability. All those things all those things are what happens when the Fed starts to raise interest rates. To make it really simple, the Fed wants those things to happen. That's why they're raising interest rates. Because if you slow down the pace at which people are spending money, you get them to stay home and you slow down businesses borrowing, you slow down the economy. Businesses can't grow, they can't expand, folks can't go out and buy the things like they were. They can't buy a new house, they can't refinance and take money out to go spend on a vacation. Those are intentional things the Fed is trying to do when they raise rates. So making sure that you understand all that when we talk about the Fed raising rates and why that has such a major impact on the US economy. So I am Dion Rabouin. We are coming now to the end of this live stream, but thank you all so much for being with us. I want to check in on the market one more time. As we look out, we see, things have not gotten better. The Dow down about 0.75%, S&P 500 down about 1.25%, and the NASDAQ down almost 1.6% right now. So remember, we talked about it at the start of this live stream. I said, let's look out at this week. We get CPI, Consumer Price Index, what we're paying at the store, at the pump, when we go out to eat. We're also going to get Producer Price Index, what businesses are paying for labor, for inputs, for materials. We're also going to get retail sales, what folks went out and spent despite or because of inflation. And then we're going to get that University of Michigan Consumer Sentiment Index on Thursday. Those are all coming out this week, and I think those are all going to tell us a lot about the economy and what consumers and how consumers and businesses are reacting to inflation. Again, Fed Governor Lael Brainard, known as a dove, came out last week and said inflation is our #1 priority. We are going to whip that and get it down. We are also going to run off the balance sheet, which adds further tightening to the economy, which makes it even harder to borrow. They said they're going to do that, and the Fed minutes from March really came and reinforced that. So that's why we are where we are, with a 2.77% rate on the 10-year yield, up more than 100 basis points from where we were only about a month and a half ago. These moves have been significant, and I think there is more significant movement to come. So stay tuned, and I hope you, like I, will be watching 8:30 a.m. on Tuesday, CPI, that number is going to be big because it's going to really tell the Fed, okay, do we have to keep going and keep saying that we're going to do everything it takes to whip inflation, or can we ease off a little bit? Can we kind of give consumers and businesses a bit of hope that maybe we're not going to raise at this very expeditious pace? So I hope you'll be watching, I'll be watching, and thank you for watching this live stream with me, Dion Rabouin, for the Wall Street Journal. We'll be back on Friday at 1 p.m., so please join us then. And yeah, I look forward to seeing you there and look forward to seeing you again Mondays and, whatever day we do this live stream. Thanks for tuning in, and I appreciate you.